Welcome to the Finance Committee meeting of June 12th, 2025. As chair of the committee, I recognize we have a quorum and I call this meeting to order. The first item on the agenda is to approve the minutes of April 14th, our special town meeting, the April 17th meeting, the annual town meetings on the 19th and 20th of May. I hope everybody had a chance to go through the minutes. Are there any issues or concerns on any of these documents? Yes, Melinda.
I just want to make a note that I was not there at the annual town meeting, so when you registered the vote, please.
Yep.
Thank you.
Any other concerns or issues? If not, may I get a motion to approve all four, the minutes of all four meetings?
So moved.
Second.
All in favor of the motion, please say aye.
Aye.
All against, please say nay. And the motion passes unanimously. We shall now move to the next item on our agenda, which is a presentation by Bartholomew and Company regarding our town investment portfolio.
Thank you, Mr. Chairman. As you recall, I've been here many times in the past. Kathleen Glowacki, who has been here many times before, she sends her best. She just became a new mom.
Oh, congratulations.
So we congratulate Kathleen. Who I have with me tonight is Alex Bartholomew, who is our Chief Investment Officer, and I also have Brian Jamross. For some of you new on the committee, Bartholomew and Company manages your long-term trust funds, your OPEB, your operation, and your bond proceeds. A bunch of different laws that apply, and then we apply the laws to satisfy the town's needs as far as the investments. So what we have before you is your OPEB and your operating. So I will turn that over to Alex. Mr. Chairman, are you going to use your computer or paper? Because we'll open it up to whatever.
Is it on the screen? It would be great if it's on the screen.
I do not have it.
You don't, that's okay, we can go with paper.
Okay, all right, we'll go with the OPEB. For those of you at home, that means other post-employment benefit. It is the money set aside by cities and towns to pay retiree health insurance down the road. So with that, I'll turn it over to Alex.
Thank you. Good evening. Nice to see everyone. It's been a while since I've been here, because Kathleen, as Chuck said, has been filling in this role for quite a while. So going through these two accounts, which couldn't really be more different in terms of investment strategy, laws, and risk. The OPEB portfolio is much like your pension, where we're putting money away from an unfunded liability. In this case, it's healthcare, generally healthcare, life insurance, for the employees of the town, both current and retired, and in reality future. So this portfolio is invested significantly more aggressively to target a discount rate from your actuarial study, and where we are in the life cycle of these types of funds for all communities is gathering assets. The number one thing to affect your actuarial study is continuing to contribute. Investing will become more and more important as the assets grow and become a greater percentage funded. But turning to look at the growth of the account, starting on page 3 here. Page 2 is a history of the asset allocation with slow dollar cost averaging at the beginning from 2011. The portfolio since inception is annualized 5.75%, ending the month May 31st. That does have more than one investment strategy over the life cycle, starting out more conservatively and ramping up to where we are now, which is common as communities started with low dollar amounts and started to get to greater scale. What we have here on page 3 on the right-hand side, fiscal year to date, 2025, which is obviously important for the community as you're going through budgetary season, up just under 7.5%, which the market has afforded after a good calendar 2024, coming off of some tough years in 2022 and then a strong year in 2023. So where we are now here, over the trailing performance, we have a portfolio that is lagging its blended benchmark of equity, fixed income, and liquid alternatives. primarily due to underperformance in the domestic equity sleeve and an overweight to quality and duration in fixed income, as we expect yields to go down because of slowing economic data, slowing labor market, and the Fed cut rate expectations with lower inflation. We've seen a lot of volatility tied to that, and perhaps starting to see that actually finally materialize here in the second quarter of 2025, even as recent as the last couple of weeks here in June. But big picture in a long-term portfolio needs to be annualizing in that 6 to 7% range for the discount rate on the actuarial study. And over time, as we build these portfolios up, which this portfolio is up over $12 million, we're going to start to see more and more of a institutional quality asset allocation. What does that mean? As I turn the page to page 6, are we going to have exposure to equity, fixed income, traditional asset classes? Of course. Are we going to be global to represent the full investable market as an institutional portfolio should for diversification? Absolutely. Domestic equity and international, domestic and international fixed income. But we're really talking about those private markets of private equity, real estate, private debt, infrastructure, so on and so forth in the alternative bucket. Why do we want those types of exposures in this type of portfolio? A, because this is institutional portfolio. We do have that lofty discount rate that we need to hit, and we can't always rely on public exposures to do that. Interest rates are higher now, which is great, but for nearly 15 years they were at 0. And then where current valuations are in the stock market on a forward-looking basis, long-term forward-looking returns may be lower than they've been in the past. Take into account a lot of other technicals, such as companies staying private longer. The number of companies in the stock market from 25 years ago is significantly different. There were well over 6,000, and we are looking at a shrinking number of public companies. The opportunities to invest in growing, stable, quality companies are more and more private. That's just an example of why we want to build out this portfolio to look very similar that you would see at the state pension system. And we're able to deliver that, and the returns have been consistent and delivering that illiquidity premium over public markets. So we look at things like the Pantheon Fund, the Private Shares Fund, Stepstone Private Markets for equity and diversified private markets exposure. Not that I have the returns here, but they are absolutely providing that premium and that diversification in different public markets. We then have Clarion Real Estate as another example of something, like calendar year 2022, something that would have been positive in a year where most of everything else was negative. So what you can expect as the town and the finance committee representing the town for this type of portfolio is to be taking on more risk, but as an institutional asset allocation, be taking advantage of all the opportunities globally, both public and private, from an investment manager that knows how to deliver that even in a $12 million account. We don't need $100 million, $100 billion like the state pension fund to deliver you the same type of quality asset allocation that you need to accomplish your goals. Okay. I don't know if anyone has any questions on the portfolio or the performance on this before I move to the operating fund.
Just a quick question. Thank you for all that you're doing. Appreciate it for the town. Curious on the alternative allocation at 17.25% as of now. Are you striving to get that to 20 and building that up?
20 is the target by IPS, and that's how the blended benchmarks are built. So we're a little underweight on the fixed income alternative side because of where interest rates are. So we're trying to, what this account is missing in this current allocation is that private credit exposure.
I was going to ask about. Thank you.
Thank you. And we have founders shares in a private credit that not the rest of our network doesn't have. That is cost efficient, and it's in private credit secondaries that has been the #1 performing fund in the space since it launched.
Thank you.
So are the private investments also included in the benchmarks that
Yes. Yeah, that's a great question. So, whether you're looking on page 4 or on page 5, we provide more than one blended benchmark. The reason why we do that is because there are no benchmarks that are perfect depending on the asset class we're looking at. And the more that we can provide, the more educational and the more informative we can be when presenting to our clients. So in those first 2 blended benchmarks where you see liquid alternatives or alternatives, which are abbreviated so that it can fit, we're using the HFRX Global Hedge Fund Composite, which is a composite of daily liquid SMAs, separately managed accounts, of different alternative hedge fund strategies. And then the second blended benchmark is using the HFRI, which is a composite of actual hedge funds.
That's the last column?
I'm on page 4.
4, okay.
So this is trailing performance. I'll be happy to show you on page 5. You have your portfolio in the first row. The second row is the that liquid alternatives, which is that part of the benchmark is priced daily. And then the third row there, where it just says alts, that's the HFRI composite of hedge funds. That prices monthly. So the blended benchmarks aren't, that one particularly isn't accurate until a month after month end because there's a lag in the data reporting. So if I were to go to page 5, it's the same thing. It's just transposed. Instead of going from top to bottom, we're going from left to right. The exact same benchmarks broken down calendar year by calendar year. And if you do want to know what is made up in those blended benchmarks, I would turn your attention to page 9, the last one, which has the disclosure, the fine print of what those benchmarks are, and then there's a glossary defining those benchmarks right after that.
And Mr. Chairman, if you recall, in prior meetings, the benchmark that we are currently using is how it is currently being invested. So as we all knew, it was started out as very much conservative.
Right.
So that's why in prior years, you would see underperformance there because you're comparing to the way it is today and not the way it was once invested.
Great. And so when should we start looking, about 1 year or 3 years? That is really of interest to us.
That's a great question. We have that tracker. Do you have that data? We can look that up. When it was invested at 70% equity, 30%, we have all that. When we get to a better performance system, we can start to chain those benchmarks together.
Right.
The current one, we can't. So it became 70-30 on October 12th of 2022. So you're approaching a 3-year number in the fall.
So we should be more interested in 3 years and prior to.
3 years and in, I'm
Yeah.
for the exact comparison to the benchmark. But we're certainly concerned about the whole track record, and when the reporting system can help us make that more accurate, we're going to do that. And then as Brian is helping me out here, we didn't start adding those private market exposures until the first quarter of this year. So it'll take time for that to mature and add value to the portfolio. So our performance in previous calendar years was 100% liquid and public.
Sorry, yeah, Brian.
One quick question. I noticed, and I agree on the private side of things and owning the equity instead of maybe some of the small cap exposure on the public side.
Yeah.
There's no I don't see any mid cap, and maybe there is some, is there an expectation to add?
That might be a whole meeting unto itself. So we had mid-cap exposure until March. Russell, because of the issues with their indices, and particularly in the Mag 7, their indices were violating the IRS registered investment company standards. And so the index providers, which are the biggest customers of the index provider, like BlackRock and State Street and Vanguard and Fidelity, complained. And so they changed the makeup of the indices. And it rendered our ability to allocate large and mid separately useless. So in March, on March 26th, I believe, is when they took their existing historical indices that were all of the non-blend indices, value and growth at every level, and they turned them into capped indexes. So the Russell 1000 growth in this case, we were trying to break it down between the top 200 growth and the mid-cap growth, but we were forced to start to allocate things 1,000 value and 1,000 growth. And we have been for a while now benchmark weighting the style boxes to eliminate or minimize allocation effect.
Thank you.
G.
Just have a couple of general questions. Are we still using on these percentages smoothing?
In what regard?
Well, we were looking at normally around 6 or 7% overall.
Sure.
Some were up 12, some were up 14, others were at 2.
Are you talking about the individual investments in the account?
Yeah.
So you're going to have fixed income investments that generate lower total returns and equity, riskier investments that generate higher total returns. We are comparing everything against its own applicable benchmark for its exposure, whether that's, a certain type of stock exposure or a certain type of bond exposure. And then we want everything to play its role in the portfolio to generate the portfolio level outcome that we're looking for.
That's total, but when we're looking at these individual percentages, those are actual
Which
look at
page
page
are you
4.
looking at?
for, just a
Page
general.
4, that,
Yeah,
all
okay.
the portfolio level performance is actual, it's net of fees, it's
Yeah,
not
okay,
hypothetical in any
That's
way.
the question I'm at.
Yeah.
The other second question is, who are we investing with?
Sure.
Who are the big boys that handle your recommendations? Is it the Schwab?
The assets are held by a subsidiary of Fidelity, the custodian, with it's
Okay.
called National Financial Services. So none of the investments are held by Bartholomew and Company.
Yeah,
Right.
okay, so they're doing the basic investment on the market.
We're doing the investing. We're making all the
Well, I
investment
make-
decisions.
They're
They're
handling.
holding it, which is no. It's very important because the custodial credit risk to the town is minimized because of the quality of the custodian
Yeah,
and the fact that it's all registered in the tax ID
yeah, okay.
of the town.
And whereas we are independent investment advisors
Yeah.
and our broker-dealer is the same, we are not told by, a Schwab
no,
or
I
somebody, you
understand.
need to buy this fund.
Yeah, no, I just wondered overall who was the road.
Yeah.
Any other questions? Milan?
So, you just mentioned that the performance that is net of fees. So
Yeah.
do we know, with fees, what is the performance?
Gross of fees?
Yeah,
The fees are, that's the bond proceeds. It's all 10, 12 basis. The fees are 12 basis points to Bartholomew and Company. So the performance system that we have here doesn't really even generate them gross of fees because by SEC rule, we're not allowed to do that. So if you wanted to, you could add that fee, but the fee has changed over time. As assets have grown with the town, with Bartholomew and Company, that has gone from 25 to 20 and down all the way to 12 basis points because we manage so much for the town of Shrewsbury.
gotcha. So is there a fee structure that we can?
We have a fee schedule by total relationship size.
So can that be shared later?
It can be, yeah, it's public. Yep.
And one more question, considering the volatility, are there any short-term, change or, rebalancing that you guys are thinking about, and
Yep.
how are we reacting to that as a town?
The short-term rebalancing that we are monitoring is if we see enough drop in rates, we are positioned to take advantage of that, and we will rein that in duration effectively. So instead of owning longer-term bonds, owning intermediate and shorter-term bonds, because we have diversification across the curve. We have bonds that mature very near term, and we have bonds that mature very long term. The long-term bonds have added to volatility in the portfolios. We've had interest rates go up and down. As we start to see rates go down and stay down and add value to the portfolio, particularly if we unfortunately get into a bad economy and a bad market, that's what we're closely monitoring right now, which is it's the overweight to duration.
Thanks.
So I just had a final question. So did you mention that our North Star is about 6 to 7% for this?
Yeah, that's generally across the board for all communities. It's uncommon to be above that.
And is that because you're targeting to just sort of double the money every X number of years or something?
Yeah, you want to grow as much as you can. In your actuarial study, which is big and thick and complicated, and I'm not trained, educated to speak on it necessarily, the whole thing, you're going to have a lot of numbers in there. And the discount rate is just one of them. It's a loose target to when you take money and put it aside for this unfunded liability, make sure you don't stick it in the bank. Make sure you're investing in a diversified portfolio to generate a long-term return that's going to help you. Granted, it's what I said earlier. $12 million, I don't know what your total liability is, but I'm sure it's a low percentage. And that is, again, a common across the board for cities and towns, not just in Massachusetts, but across the country. We are still in the infancy of putting money away for OPEB, where pension is near 100% funded for almost everyone. And in most cases, even though the goalpost continues to get moved, a lot of communities are looking toward being fully funded on their pension and starting to redirect those efforts towards their OPEB sometime in the 2030s.
Any other questions related to OPEB? Really?
I think one more question, again, just more curious.
Yeah.
I know you manage other towns also.
Mhm.
So do you guys generate a report like similar town size as ours? Like how do we compare with our peers?
So the way that we manage all of these, we are lucky that our clients listen to our advice, and they're invested almost identically. They do happen on different time frames, but the town of Shrewsbury is invested exactly the way that we recommend, minus that private credit fund that we were just talking about. So other communities that are invested the same way are in a very tight band of performance. The difference to you that is actually a benefit that others can't say is they can't say they're only being charged 12 basis points because of the unique size that the town has with Bartholomew Company. So others are paying probably double that.
Thank you.
Any other questions? I guess we can proceed then to the operating fund.
Sure.
Okay, the operating fund, as we all know, follows a totally different law. This fund is here to make as much as you can while keeping it safe. And we take in this account, there is no equity risk. So it's pretty much the entire account is fixed income.
So we do invest this pursuant to the list of legal investments, which Chapter 167, Section 15A through K on Mass General Laws. And like Chuck said, we do not have equity exposure in here. We do manage this to a 1 to 3 year bond portfolio, so it's very short. It's all investment grade. It's made up of cash, treasuries, and corporate bonds. So on page 2 here, we can really see that breakdown by what this is called asset subtype, but bond sector. It reads from right to left. So the most recent time period on the left-hand side, portfolio has a current yield of 2.15%. We are going to look at yield to maturity and show what that really looks like, because current yield is not representative of the return profile you have going forward. That can often be a misnomer. But the number one exposure is corporate bonds. We're also going to show that breakdown from a credit quality perspective is very high quality. So money markets at the end of the month at least, and cash, unsettled cash, was around 5%. That's in reinvested cash. We like to keep that more at 1% target. We have a small amount of government agencies left, and about 1% in a bond ETF of agency mortgages. By law, we're not allowed to own agency mortgages directly, so we have a little bit of exposure in a diversified vehicle. So this portfolio track record dates back not to 2011, but to 2001. So, thank you very much for the town's relationship with Bartholomew and Company, which honestly predates that, but this particular account back to November 2001. Over that time period, through a lot of different interest rate environments, the portfolio's generated 2.3% annualized net of fees, and fiscal year to date with the interest rate environment we are in, it's up over 5%. I'm so thrilled that we can look at a number like that because for 15 years we were basically near zero. It's fantastic. So the total gain for the first 11 months of the fiscal year is over $4 million, bringing the account size to over 82. And as you can see in the graph below on page 3, there have been large contributions by the town in the last 3+ years to bring the total value of this portfolio up a lot higher, take advantage of higher interest rates in the fixed income market. So this is what I want to start talking about here on page 4 in the upper right-hand corner. If you take no other data point away from this, please look at that 3.94%. Compare that to the 2.15% you saw for current yield on that first page there. Yield to maturity is really the representation of the return you have on a forward-looking basis, because that's not just taking into account income, but appreciation in the bonds to par. And the duration of the portfolio is 1.83, so less than 2. Some people call that 2 years, just to label it, but less than 2 on duration. So a very short portfolio in maturities and duration, very high quality in a single A+ weighted average credit rating from Standard & Poor's, and we have nearly 4% return. Net doesn't take into account any return from the money markets or the ETF. Again, that number is gross of fees because it's just a statistic on the underlying investments. And then we can see the breakdown on page 5. Why is the difference between current yield and yield to maturity so different? Because there's a lot of bonds in the portfolio that have coupons less than that 4%, which is fine. Depending on the type of bond, that's okay. If we buy a 1% coupon bond at 95 cents on the dollar, we're going to make the same return as if we buy a 4% coupon bond at par. There are subtle differences, but math at the end of the day ends up being the same type of return. And then again, just to drive the point home here at the bottom of page 5, that credit rating table, nothing below BBB. BBB is the lowest rung of the investment grade scale. And the reason why you have so much exposure in that AA+, because all the rating agencies now, with Moody's in the last 2 months, consider the U.S. Treasury to be less than AAA. And Standard & Poor's has considered Treasury AA+ since July of 2011. So a very, very conservative portfolio, and one that's thankfully delivering returns now with interest rates going up throughout 2022. As we turn our attention to the returns, we have our trailing returns and then calendar year returns on page 8. Year-to-date, calendar year-to-date, up 2.31% versus that. In this case, the main index we want to use is that 1 to 3 year government credit. So the difference between this and U.S. aggregate bond index, if you're familiar with that, is it strips out the mortgages. And again, why do we want to strip the mortgages out of the index? Because we can't legally own them anyways. So we can only own corporate bonds. We can only own treasuries or agencies. We technically can own CDs too, but with a $250,000 FDIC limit, we'd have to buy a lot in an $80 million account. So it's, and they're not nearly as liquid. Agencies and CDs, in terms of liquidity, are significantly different than the investment grade corporate bonds we have and the treasuries that we own. So in the mindset of safety, liquidity, and yield, we definitely put a high value on liquidity, and we don't want to sacrifice that in a portfolio like this. So over time, that 2.3% for over 20 years is nice. You can see that 5-year number of 1.57. If I had a 10-year number on here, it'd be similar to that, a lot lower, representative of zero interest rate policy for quite a long time. But if you start looking at 3 years and in, you're going to start to see higher numbers representative of a higher interest rate environment. And our challenge in this portfolio, or any of these portfolios that we manage in short-term, high-grade fixed income, limitations of what we can buy on the legal list. We can definitely make do. But we do overweight corporate bonds versus the index in order to make up for things like management fees, cash drag, withdrawals, because when the town takes money out, we do have to sacrifice, the portfolio we've set up at times and wait for it to kind of fix itself. So over that 5-year time period, giving a relative return that equal to or better than the index net of all those hurdles, we're very pleased with. There's a lot of numbers here on these tables on 7 and 8. Happy to go through any of them, particularly the calendar year by calendar year stuff. And I don't know if anyone wants me to go line by line of the portfolio holdings, but what you're going to see in the corporate bonds on page 9 are a lot of recognizable names to you, perhaps. A lot of healthcare names. There's not a lot of financials that we can choose from. But a lot of high quality. And we even hold Johnson & Johnson, which is one of the few AAA rated bonds in the market you can buy still, particularly after the United States Treasury was downgraded to AA+. So what we see going forward here is that we are trying to push these to the outer end of our weighted average duration. And what I mean by that is like 2.5, as we see rates coming down on the front end of the curve. And we will see this yield to maturity of 4% go down over the next year to 2 years. We just hope and pray it doesn't go back down to 0. We expect it to land somewhere in the 3 range.
So I just had a stupid question. As far as the fixed income, something like a high interest savings account, they don't apply to this? Like, is it the FDIC limit that you mentioned?
Yeah, the FDIC. So the biggest challenge when you have a lot of money is all these nice problems to have, right? When you have an $82 million account, you have to be very concerned about where you custody your assets and how it's protected. So if you put it in a bank, if you only have FDIC insurance, it's only up to $250,000. A bank could have DIF. And then what is the rate that they're offering you? So, and if you needed to take the money out, do you have access to it? Is it liquid? When you have this amount of money at a investment custodian like a subsidiary of Fidelity, the protections are significantly more. And at a bank, one way to protect your assets is to collateralize it. What a bank would do in that case is they would buy treasuries to collateralize your checking account, your savings account. Here, you're buying those treasuries yourself. So you're collateralizing your own assets, and you're obviously benefiting from it, at least now. For a while you weren't. So.
And then as interest rates drop, you're going to want to lock in some duration there so that you don't follow the rates down. And having an investment portfolio like this, if you just had it in a bank, you would go up and down where the short yields are, versus having an investment portfolio, you can protect yourself by extending duration, as Alex just said.
Any other questions, Brian?
You mentioned National Financial Services as the custodian. Are there other custodians that you would be comfortable with in the future?
Yes, custodians of the same or larger size that are going to give us access to government-only portfolios for institutional investors, not prime funds. We don't know what they are yet.
Okay.
Thank you.
Jim?
Alex, you actually triggered a thought, and maybe Chuck, you can remind me. Did we meet, when we last met, was there an opportunity where what we were eligible to purchase changed, and we were having a conversation about that? Is my memory serving me correctly?
100% correct, but not in this account.
Okay,
That would have been in your trust funds.
trust fund, okay.
Where you can get off of the legal list,
That's right.
and then move to the prudent investor statute.
Okay,
And I believe we've done that in that account.
great. Thank you for the reminder.
Gene?
One quick question on these bonds. You get many callbacks?
That happens from time to time. Almost every single corporate bond is what's called a make-whole call. So it's a formula, but say it's trading at a premium, say 110 instead of 100. They're going to give you that 110 back. They don't do that. And if it's trading at a discount, they'll just go into the market and buy the bonds.
Yeah. I just I had, one time I bought some bonds for Harvard for expansion.
Yeah.
And it was a great rate, and got partway through them, and they said, oh, no, sorry.
So that happens a lot more in the municipal space,
Yeah.
tax-free debt space, which Harvard probably issued through, or agency debentures. But in corporate bonds, we're very cognizant of our call risk.
Yeah.
It does happen, but usually, believe it or not, the calls are like 30 days before maturity. So
Yeah.
it's immaterial.
All these corporate bonds listed are all everybody usually recognizes
Yeah.
the company.
We do wish we could look at more. We are limited in what we can look at, but we are able to make do for sure.
Milind?
A couple of questions. On the fixed income distribution, it's using bond holdings, so what do we qualify as cash? Do you exclude cash and the money market as well? Like, what's the definition there?
Yeah, so yes, the money market and the cash. The reason, as of May 31st, 2025, you have this line item called cash, whether it's on that portfolio allocation report at the beginning or on page 10 at the bottom of portfolio holdings, is because that's an unsettled maturity call or sale of a security. So that's not actually a security. If I showed you the same portfolio holdings as of June 1st, that cash line item wouldn't be there. It's just in flux as we get it reinvested.
So everything gets invested and everything is treated as
All that data to the bond
the bond holding and TNAs.
bond distribution, fixed income distribution report is only representative of the individual bonds, of corporate bonds, that one agency that we have left, the handful of treasuries, excluding the ETF,
Yeah.
the mortgage-backed ETF, and excluding anything that shows up under money market and cash.
So I think if we can add a disclosure, what the portfolio bond holdings would be, I think that would be good
Okay.
in the disclosure. And then on the fixed income distribution, again, I know I was just looking at the duration, the average duration is 1.83 and the coupon is again 2.11. But I think primarily they are falling under the second bucket, 1 to 5 or 1 to 5 years. So can we expand next time just to show the each yearly buckets or the coupons?
Year by year?
Yeah, just to get
I-
some.
I don't have at that all the flexibility in these reports. We are limited in these fixed income reports.
I mean, I can derive from individual holdings, by highlighting
Yep.
the name and finding out, but
Yeah.
I think that level
There's
of
ways
aggregation
to
would be
add
helpful.
a little bit more, breaking it down fixed income by maturity in order by maturity.
Yeah,
But it's still going to group it less than 1 to 5. Unfortunately,
Yeah.
it doesn't. Our current reporting isn't that granular.
Got it.
But I'm happy to provide
just
any
want to-
detail or commentary that is helpful.
yeah, I just wanted to, similar to the S&P rating, I just wanted to see
Yeah.
how others are kind of spread
I like
out.
how that
Yeah.
is displayed. Believe it or not, that table rating, we're almost lucky that we have a bond in every rung.
Yeah,
Because if I didn't have anything, we have one position in a single A plus. If we didn't have it, wouldn't
It won't
include
show
it
up.
there.
yeah.
Yeah, so there's limitations in a lot of individual fixed income reporting in our industry,
Oh.
because everyone's so focused on stocks and equities. We're really squeezing the most we can out of this system presently, and hope that that's going to get better in the future.
Yeah. So if it allows, maybe.
Absolutely. Yeah,
Thank you.
absolutely.
Any other questions? May I request that we get soft copies of these presentations for our records? Yeah, that would be great.
Yeah, digitally, absolutely.
Okay, thank you, gentlemen. Thank you for
you.
Thank
wonderful.
you. Good night.
Have a good night.
Good to see you.
Thanks, guys. Good to see you. Have a good night. Thank you.
We shall now move to item number 4, which is the town manager's report. We will start with item 4A, review and act on the reserve fund transfers for street lighting, utility, and electricity.
So we have just one reserve fund transfer request to hopefully close out the rest of the fiscal year. This is a request for $8,183 for the street lighting budget. And this is due to Selco rate increases that went into effect on May 1st. So this is what's needed to cover the May and June bills.
Could you just have that amount again, 8,000?
$8,183.
Any questions or comments?
So
David?
was this increase expected, or is it just kind of a surprise?
And it went into effect May 1st, and they started working on it in January, so.
Okay. Is that going to be something they're doing, is increased rates? We'll say?
It seems like they are more apt to do that than they have been in past years, especially in not hold the municipal accounts as harmless as they have in the past. So we have increased our engagement and requests for information to try to stay ahead of this a little bit better.
Right.
And we did make an adjustment at the fall special town meeting, transferring about $50,000,
Right.
anticipating it. So that was based on the fall rate increase, and so this is just, there's a little bit more that's needed.
Because they also increased, well, the internet got increased for the library, 45,000.
Yep.
So I know at the presentation, they talked about, between the two town meetings, not raising rates, not raising taxes to pay for anything. So is it their plan, as far as you know, to charge the town more? So it's almost a pass-through tax, if that makes sense?
Well, so the library and the internet side of the house generally is just getting to the rate models that have been in place for the private residents and commercial businesses where the town hasn't been paying. So that is the biggest change that we're seeing there, which I believe is fair and the right thing to do, because otherwise the private customers are subsidizing the town's rate. I don't think can you ask that again? Sorry. I lost
So
my train of thought.
it just, my concern is that they go, enough to town meeting, we're not gonna raise your
Right.
rates more than like $1, we're not gonna get taxes, but what they do is they come up with a way of charging the town more, which is sort of a pass-through tax, if that's a strategy, and I don't know if it is, it just seems,
I don't think that it would be, and our municipal rates are still slightly subsidized in comparison to the commercial rates or commercial equivalents, so we still do benefit some because there is a municipal rate, which is lower than the commercial rate. So, but I don't foresee that happening. This is clearly a time of transition in business models with Selco and their rate setting process when it comes to municipal accounts.
thank you.
Sure.
So Kevin, are you're not surprised by the $8,000 transfer request based on what some of the feedback you've mentioned, saying that it started back in January and here we are, the end of fiscal year? Are
Well,
you surprised or not surprised?
I
I'm
am
just curious.
surprised.
You are, okay.
Yeah, I am surprised.
I wasn't sure. I was trying to
Yeah.
read between the lines a little bit.
No,
but,
we definitely are. I mean, as surprised as getting an invoice and saying, literally within the last week or so, that,
Thank you.
Yep, yep.
Did they communicate, like, is the rapport still there that maybe that you can see these
Yeah,
things or
I think-
anticipate, or just from a communication standpoint? You know, to piggyback what David said, it just seems like there's been a silo building
Yep.
for some time now.
yep,
And, you know, I echo a lot of what David had said, and to hear this today, I'm just
Mhm.
curious on behind the scenes, like the communication
Yeah.
piece.
It's been a little bit frustrating, to be
Okay.
quite frank, and we're diligently working to improve that and request the information. And also, my biggest request to Selco, which I will be working with the commission on, is getting municipal rate adjustments to be for July 1 and not throughout the course of the year, right? I mean, that is the number one request that I have in, and just be, you know, I understand their business cycles don't work in lockstep with a fiscal year, but it's incredibly challenging for us. And if you look at this account, it's doubled in the last few years,
Yeah.
so.
Okay.
yeah, it has been a little more frustrating than I would like it to be, and we're working to try to get that communication and just see that Selco doesn't do their business without regards to the impacts that it has on us.
Well said, thank you.
Gene?
Do they have to do any justification on the increase?
They do when they do their full rate setting. They do show, you know, costs and long-term, you know, energy supply and their operating costs whenever they bring it before the commission to set rates. Communication would be number one.
But if they do it then, they should be able to tell you what the total is going forward.
Yes, I definitely agree. It's just the timing of when they're doing it throughout the fiscal year and how it's hitting our budget is what we're really dealing with here.
So just for my understanding, July 1st, we've already planned it in, the increase?
Yeah, so the FY '26 budget proposes a 40% increase over FY '25. So we know the monthly rate that we will have at least for the next 6 months until they evaluate again in the fall. And then we have a little bit of a buffer. We built in a little bit of a buffer to hopefully account for the next 6 months after that.
So I guess that's the question, how often are they adjusting rates?
I believe this, at least this past year, it's been twice.
Twice, right.
Any ad hoc date they choose, it's not based on any cycle of theirs? Any fiscal
I
cycle?
mean,
that,
it follows a traditional utility cycle adjustment of like a pre-winter and post-winter. Like if you follow the Eversources and the grids, that's when they make their adjustments. So Selco is a little bit closer to that timeline for that.
So is there like I mean, have we studied like, I know we are on a lower end than others, right? But then have we figured out a formula like, you know, if other providers go X percentage, you know, we can anticipate X minus something to hit our budget, just to better planning perspective for us, right?
Yeah, I don't think so, and, but I think that's a good thing, because Selco is setting rates based upon their operating expenses and their ability to aggregate and purchase energy at a lower price, at a low price, through a variety of methods. That's wholesale purchasing, how they do it in consortiums with other municipalities, and long-term contracts through, you know, a variety of renewable and non-renewable sources. So we've always been lower than the investor-owned utilities, but it's not a strict percentage of those.
Thank you.
just last question, our reserve fund will go up again July 1st, right? Because based on the budget, okay.
Yeah, where we stand right now, we have about $66,000 left.
Before this.
Before this transfer, this is an $8,100 transfer request, and, I mean, if we had foreseen anything else, we'd have brought it to you this evening, and we don't. And we feel that most municipal budgets have sufficient room to cover what we need for the rest of the year. All final invoices and bills are due by July 15th, and we've asked departments to make appropriate year-end financial preparations to carry some funds forward, to have a little bit of flexibility, which would then just get turned back to free cash if it's not needed.
So
David?
when will all the accounts be washed and the money returned?
So whenever we get free cash certified, probably near the end of September would be the final.
That's kind of late compared to what it's been in the past.
September? Yeah, I mean, it's still early on the municipal side, but, yeah, I mean, we'll try for earlier in September if we can possibly get it, but, you know, always want to have it in advance of the deliberations for the special town meeting in the fall.
There are no more questions. We can vote on this. May I get a motion to approve request number 9 for a transfer from the fiscal year 2025 reserve fund for street lighting?
So moved?
Second.
All in favor, please say aye.
Aye.
All against, please say nay. The motion passes. We shall now move to 4B, the status of the fiscal year 2025 revenues.
So printed out before you, you have a snapshot of Schedule A local receipts. This is through June 1st. And as you can see, we've exceeded budgeted local receipt revenue by a little over $2.27 million. And again, we do have one more month to collect, and this would include commitments 2 and 3 for motor vehicle excise, which is about $600,000. Another quarterly payment of other excise tax, and then we typically get a bigger investment income quarterly as well. So looking to definitely, I don't think it'll be as high as it was last year, but still looking to exceed budgeted revenues.
So we are having a history of exceeding our projections.
Yes.
Do we have any insight as to why? I mean, it's great that it's always great, but
Yep.
do we have any insights in terms of why that's happening?
Well, a lot of that investment income that you just heard Bartholomew talk about in the operating budget being at 5 or almost 6% is the investment income that is in local receipts.
Okay.
So
Yeah.
when that is 2 or 3 percent higher than it has been, that's really been what's driving the most of the growth in local receipts. Of course, motor vehicle has also been a pleasant surprise that we can't keep up with, right? That has grown by almost $2 million or so over the last 3 to 5 years. If we look at, it's grown $1 million since FY '23 alone, and that's tremendous value on $50 on the $1,000 for vehicle value. So
Even building fees, I think during the COVID period, we had a big bump.
yeah, I mean that has stayed steady. Those are your building permits, and then major commercial projects like Physique Instrumente on Route 20 and Centec North, and residential developments come along as well. That's when those really get hit. A project like UPS, although we only have 30% of it, that would generate almost $500,000 in building permits alone.
Last thing before I open it to the other floor, that the trash and landfill, we're eventually going to lose that. So that'll be a significant hit, and I know we've talked about it in the
Yeah.
past in terms of plans to
Correct.
make up for that revenue. I don't know.
Right,
what,
yes. So right now, we're looking, I forget what the number is, 2032 or something like that. So definitely getting near the end of the space that's available at the landfill.
Is there a plan for the additional income that we didn't expect, what to do with it?
It'll go to free cash.
Well, no, I know, but I didn't know if there was something, you said if we have extra money, this is where we want to put it, or no?
Not yet. Yeah, I mean, we'll look at the capital needs and other one-time investments, and once we get free cash certified again in the early fall, we'll make those preparations for town meeting, but no specific plans right now.
Okay.
Gee,
Could you talk a little bit about 22 miscellaneous?
Sure. These are categories that are identified by the state. So the supplemental, miscellaneous recurring Medicaid is federal reimbursement for educational services that are provided to students in need. Supplemental tax is from the town adopting the general laws that allows us to assess value that occurs between January 1st and June 30th for real property. Homeless transportation is a state reimbursement, a federal reimbursement account. So when we transport homeless students or individuals characterized as homeless, then we get a federal reimbursement. It's called McKinney-Vento. Let's see, I'm not sure what the motor vehicle reimbursement, line item was for this year. The $38,000, I'd have to look into that. Alex, gas and oil is reimbursement from Selco.
Yep.
The E-rate is a state reimbursement program where we receive funds off, to subsidize the cost of internet services at the library and schools. And, non-recurring impact aid. I don't know what that is off the top of my head, the non-recurring impact aid. I have to look into that.
Was that solar just an increase?
So the solar is Selco making up for the taxable value that Wheelabrator deducts from their payments to us. So since the solar is a private entity on the public landfill, there's real property tax that is charged to it, and it's charged to Wheelabrator. So since that wasn't part of the original lease agreement with them and they have to pay this, Selco reimburses the town on the back end for that, since it's their solar field.
But they gave us more than what was
Yep.
originally
Correct.
estimated?
Yeah, because it's a valuation,
Value.
yeah.
Thank you.
So, I'm sorry, with Selco, you expected 70,000 and you got 24,005. Is that a reimbursement to the town?
Yes.
And it's less because of less use or less because they wanted to pay less? Like, what was the cause of that?
It could be less just at this point, just based on timing. This may be something that they do twice a year,
Oh, okay.
quarterly.
These are the things that we will, you know, this time of the year really start to tick and tie together and make sure that we have all our revenues in that we are due.
So the ones that are zero, is that because, like the rebates and all that, is that just because we've not collected yet, or we
Yeah.
have received?
Yeah, and it could be a timing issue, where we will receive it before the end of June, or sometimes it may slip into the following July, and that's where we have to book it, so, it just
Okay.
depends, since they are reimbursements, or the E-rate is a reimbursement.
Milind?
So this motor vehicle reimbursement, I just see that 38,000 only in 2025 YTD. It's not there on the
Yeah,
variance column.
yeah, we didn't anticipate that at all, receiving funding in that category, I'm not actually sure what that is.
Yeah, but then don't we want to add that to have that total in 2 million?
Oh, the variance,
Yeah, yeah.
yeah.
So
You
would
see
it-
what it's saying
Yep.
there? Yeah,
Yeah.
you're right.
Yeah.
We'll double check to make sure it's flowing into the right column, thank
Okay.
you.
Thanks.
Any other questions or comments? Okay, thank you. We can now move to 4C, which we're going to review and discuss the reorganization of the committee. So we did have a discussion, we did briefly talk about this in our last meeting, prior to our town meeting. We are up for reorganization for this committee, and we were talking about a process, just to remind everybody about how we're going to choose our next committee for the next session starting in the fall. We had two ideas the last time. One was a nomination committee, similar to what Jean had experienced in the earlier days of FinCom. And there was another proposal that we just propose names and we vote at that time. So I open it up to any comments or discussion points people have on it, and how they would like to proceed.
Gene, do you want to talk about how it would work?
Well, basically, the way it worked in the past was the chair would assign or ask one or two members to become the nominating committee. They would then talk individually with the members of the committee to see what their interest was in the chairmanship on there. That's the way we handled it for a number of years on there.
And you did mention, Jean, that there was a concern that the same person would get assigned again and again.
Yeah, that,
Yeah.
that could happen, but you can put restrictions on that too, on there. I'm sure you've had enough of being a chair, so
I was hinting at that.
it's time to just become a member again.
So I think, I mean, I like the nomination committee idea, and I think we should consider term limits as well, especially for the chair. And I'm open to suggestions. I think a 2 to 3 years is a really good term limit for somebody to really do their job, if they have the confidence of the committee. But after that, we should break up and give other people a chance.
I would agree, Vikram. I like Jean's idea. I mean, I'm entering my 3rd year, and I know we'll see some changes as we look forward at that. Creating a subcommittee, and that way we can engage others and see what they're thinking and what their future plans may hold. And then, not to jump ahead, I know we're not gonna get there today, but give us some time through the summer
Right.
to have those conversations and circle back if we don't reconvene in July or August.
Yep.
So I would be in favor of Jean's original recommendation.
Anybody else want to say anything? Any ideas?
I think that's a good idea too. Just that way you can talk to people, get their feelings, what they want, and then get the list of people who want for different positions and just bring it up at our next meeting and just do the vote that way.
Should the nomination committee build a consensus prior to that and nominate a single set of,
I think that will make the process simpler, but
yeah,
Okay. Do you foresee it like, I know when they pick people for committees in the select board, they send it to the town manager's office, and Alex would send us out, and then we would put who we think, and then we'd go back, and then, does that make sense? Like, if you had a list of 4 of us wanting a position,
mhm.
we'd go out to each of us, and we could mark who we would like to nominate, and we go back, so I think what you're saying is the idea is we come back, we have our nominees. Is that what we're saying?
I'm gonna look to Kevin, and is that accurate, what David just said, on what other boards do?
No, they
Great
do it to
question.
pick people for the boards. So
Oh,
the
for other
boards-
board, not for their board, for
No,
other.
no,
oh,
I'm sorry. I'm
Okay,
sorry. When they nominate someone to the boards, that goes to
okay.
town manager's office, and they're the ones, that way we don't have, we're not all talking to each other.
Yeah.
Got it.
So when we would come in the next meeting, we would say, the person who was nominated by the committee is this person, that person. It would make it quick. I mean, is that how you want to do it? It's fine.
Since it's internal, I would, and we have to collaborate internally a lot with each other. I
Mhm.
mean, as a committee, I would be more inclined to the original recommendation, but I leave it to
Okay.
everybody else that, the
no,
nominating committee.
I would agree
yeah,
the nominating committee
Yeah.
just,
because they can
handles it.
decide, and we are a team, we work together, so we can provide that input to the nominating committee.
But to David's point, the charter for the committee would to make sure that there is a conversation with everyone who's
Yeah.
Right.
who's
Yeah.
on there.
I just want to make sure that
Yeah,
everyone gets
no,
touched.
I agree, I hear what you're saying.
Yeah.
The other thing that is happening too is you're gonna have some new members coming on.
Right.
Mhm.
So, it's kind of depending on when you're meeting, when he's gonna assign, whether they're gonna be part of it or not, or whether they even should be part of it. That's another decision too, that we used to go back and forth with. Because I remember one time we got 3 new members at one time, so.
I guess my preference would be to leave it to the current committee members, rather than wait for the new committee
Yeah,
members to join, right, to be part of the kind of nominating process, so.
I think new members should not be eligible.
Yeah.
Well, that's a fair point, though.
Yeah.
It's a fair point. And to Gene's point, I mean, when I started this year, I didn't really, Vikram, I knew a little bit, I knew some of you in passing, but my vote was an educated guess, we'll say.
I think we have an agreement on the process. We will assign a nomination committee. How many people? The question is, I think, one person or two people? That's the question. I think there should be, just for transparency, there should be at least two people
Yeah.
in the committee.
I would agree with that.
So that they can work together. And, because if we use this process going forward, it should not be only for us, but hopefully future committees as well.
And then coming back to charter, are we talking about nominations for only chair, or
No,
All
all,
Yeah.
all-
All three.
All three.
I just want to make sure.
Yeah, good question.
And I personally feel that the chair specifically should not be in that nominating committee.
Agree.
And at least for the chair, we should have a term limit.
Is that an action we can take, or does it need to be on the agenda as a specific line item?
Well, I think it would depend how formal you really want it to be. If you want it to be kind of a rule of thumb versus a procedure of the committee. You know, if there's a meeting of the minds, you may be better off with that, right? But it's up to you. If you would like to have a policy of the committee, then we would have to do that once it's on the agenda.
I'd say almost just reflecting back on my 3 years, I mean, kudos to you, Vikram, for stepping up and doing it. I know traditionally it's been a 2-year role, and this is your third, correct?
30, yeah.
And I think it was the right decision looking back, because there's been a lot of turnover even before, I'll speak for myself, I got on the board, so.
I think
I
for
don't-
now then, since we don't have a specific item, right, we can just recommend that as a rule of thumb, but, and I think I would be comfortable with that. I don't think we need to make that something that's a policy of the board
Right.
forever,
Yeah,
so.
it can just be an honor system and
Yeah.
move forward. And
General guide.
it's an agreement between us
Yep.
and hopefully future committee members as they come. And we can continue the tradition.
I think, in my opinion, I think it will be good to formalize policy at some point in time. I think it
Okay.
will be good to document, because, I mean, we are not going to be here forever on this, but, so it will be a good guiding principle for any new members, new
Mhm.
committee to come forward.
Okay.
I mean, I agree with what we are talking, but I think we don't have to formalize during this process. I think sometime we should think about that.
I think maybe we should give it a couple of runs.
Yep.
And then we'll be
Mhm.
able to get some experience,
Absolutely.
and then we can formalize it.
Yep.
Maybe 2 years down the road, we can
Right.
formalize
We
it.
should set that goal,
Yeah.
work towards that, I think.
Right.
That would be good.
Okay, so then we come to the real point. We have to nominate a committee, nominate a nominating committee. Are there any volunteers? Or does
I'd say as current vice chair, seeing, and I agree with your comments earlier, that maybe the current chair shouldn't
Mm,
be, I would be willing to volunteer
okay.
for one of the spots if the board sees fit. The committee sees fit, excuse me.
Do we have a second volunteer?
I can volunteer.
Wonderful,
Yeah.
wonderful.
Great.
Okay, so I don't see we have to vote on it. We just have to say that there is a consensus
Yeah.
that Jim and Milind will be our nominating committee, and they will come up with a list of people for our next year's executive, what do we call it? What do we call ourselves, executives or officers of the committee?
Officers, probably.
Officers of the committee. And our, after summer, that'll be our September meeting, hopefully, unless we have meetings in between.
Okay.
Okay, great. That was great, wonderful. We shall now proceed to number 5, item number 5. We have to come up with an amount for our reserve fund transfers that we can ratify, that I chair or the other officers can ratify during the summer months. So last year, I think it was $15,000, was that correct?
I think so.
Is that an aggregate or per
It was-
time?
Total.
It was
Aggregate of
Yes.
total.
it was 10,000. unless we upped it, which is fine.
I think it was 15. We did up it because,
I feel like we did up it.
yeah, we did up it. We had to take into account inflation.
Don't worry about, 15 is fine with me.
Yeah, I think 15 is a reasonable amount.
Yeah, I think it was 15.
15. Okay, do I get we have to vote on this, right?
Yes.
Yes, okay, so may I get a motion to authorize the amount of 15,000 for the chair, vice chair, or clerk to sign as reserve fund transfers during the summer months?
So moved?
Second.
All in favor, please say aye.
Aye.
All against, please say nay. The motion passes. Item number 6 is basically to postpone the nominations that we just discussed to our next meeting, which will most probably be September unless we have a July and August meeting in which we'll have to postpone it again, if my memory seems correct. Yes. Okay, so may I get a motion to postpone the reorganization of this committee to the next scheduled meeting if there is no July or August meeting?
So moved?
Second.
All in favor, please say aye.
Aye.
All against, please say nay. The motion passes. We shall now move to item number 7, which is our meeting schedule. July 17th is tentative if needed. Similarly, August 21st is tentative if needed. But our definite meeting will be September 18th, 2025. Is everyone okay with that schedule?
Yes.
I just want to comment, considering we just volunteer ourselves, I'm not available on August 21.
That should be fine.
Yeah.
I don't think we'll be able to do it till September
Yeah.
18th.
I don't
College
know that
drop-off
we've met
week,
in the
you know.
summer.
No, I know,
Any of
but,
the
I
years I've
just
been on
wanted
the
to recognize
Yeah,
that
and-
just in case it comes up.
Even if we do, we'll probably postpone, do a
Mhm.
similar vote to postpone it to
Okay.
September.
Thank you.
We can move to item number 8. Does anybody have any other business they would like to discuss?
Yeah,
David?
last time we met, we also talked about a financial risk thing when you spoke about. Was that something we were gonna do, or I forgot if it was something we had to work on, or?
I think we wanted to kind of get together and kind of formalize, like, what does that mean? I
Right.
think there is some more brain power that we need to probably decide on
Okay.
as to what are we looking at, what does risk mean for the town and the finances?
Right.
It's
Is
good
it
point.
something that the town manager has anyway? Like, do you guys have a risk management thing? Okay.
No, it's not a term or, kind of concept that's used very widely in municipal finance. But, I'm happy to explore that with you all and see if there's something that makes sense that we can, come up with.
I think if that's something we want to explore, right, I think it would need to be in collaboration with you and your staff, Kevin, right? Because I think that will, it has to be something that you guys can help pull together for us, right? So it has to be something that you're comfortable with as well. So I think that would be my only comment.
Anything else? Any other business?
I just wanted to acknowledge, Rajesh Velakapudi's, presence and service, volunteer service here on the committee. I know he has moved on to school committee now, but I just wanted to recognize, he was part of this committee and, definitely contributed towards the operating of this committee as well, so.
Yeah, thank you, Milind. I second that.
Mm-hmm.
He's someone we'll miss. If there's nothing else, we shall move on to item number 9, which is correspondence. We received an email from Mr. Stephen Boksansky, the BCP Government Relations Incorporation regarding Article 29 dated April 16th, 2025. We received an email from our state rep, Hannah Kane, regarding the update to the House passage of a $61.4 billion fiscal year 26 state budget dated May 1st, 2025. We received an email from Henry Schwan of the Worcester Telegram and Gazette regarding a reporter request with a story deadline, and that was on May 20th, 2025. And we received an email from a student at the Shrewsbury High School, Akshaj Anini, regarding a summer internship opportunity. That was on June 5th, 2025. Any comments or questions related to the correspondence we received? If not, may I get a motion to adjourn?
So moved?
Second.
All in favor, please say aye.
Aye.
All against, please say nay. Have a happy summer, everyone.
Here's one.
Thank you.
Thanks, Vikram.
And so,